best investment factors all have an element of human behavior within them, whether it's value, whether it's momentum, whether it's quality. All of these things persist for hundreds and thousands of years because they have an element of human behavior to them.
This is the Door World of Money podcast. I'm your host, Rob Berger. In today's episode, I'm speaking with Dr. Daniel Crosby. He is a behavioral finance expert, a best-selling author, and host of the Standard Deviations podcast. Daniel is also the Chief Behavioral Officer at Orion Advisor Solutions and a seasoned TED speaker. Daniel, welcome to the show.
Thank you. It's great to be here.
So how in the world did you marry, I guess, psychology and finance? How did those two end up coming together for you?
Yeah, it was a bit of a circuitous route for me, because I'm a clinical psychologist by education. So my PhD is in being a shrink. I set out initially to help individuals with eating disorders, and found a few years into practicing that candidly I just wasn't cut out for it. Like, it was just too stressful for me. I was taking my work home with me. I worried about my clients sort of to the point of distraction. And I just really had a hard time doing it 40 hours a week, even though it's, meaningful work that I believed in and still believe in. And so I was looking for a way to apply my love of thinking about why humans do the things that they do and act the ways that they do in a non-clinical setting. And I brought this sort of conundrum to my father, who's a financial advisor, and he said, "Well, hey, there's a ton of psychology in my work." I mean, I was all of like 25 years old. I was about halfway done with my PhD at the time, and was like, "What are you talking about?" I had always sort of thought of my dad as a numbers guy, as an analytically minded guy, and thought that his work was relatively black and white. So this was the beginning of my discovering behavioral economics, behavioral finance, and sort of led me on a mission to try and help folks like my dad bridge the worlds of academia and practice.
Hmm, that's great. Well, I'm going to really need to tap into your knowledge today because I've got a lot of questions about emotion and behavioral issues around investing. And I want to start with something that I understand you don't update today, but the Irrationality Index. I'm looking at the market today as we record this episode in December, and the market's up, which, it seems to have been up and up and up for the most part for quite a long time now. And so I think it's like a good time to talk about it. And so even though you don't update the Irrationality Index, I'd be curious if you could sort of just describe what it is for folks, and maybe we could talk about how rational or irrational you think the markets are today.
Yeah, so the way that I created the Irrationality Index was by taking, I believe it was 45 different variables that are commonly purported to be indicative of market sentiment. So everything from sort of new high, new low indicators to valuations to momentum, and sort of everything in between, consumer price surveys, things like this. And I regressed them against performance and tried to determine, which of them mattered and the extent to which they mattered. And so the headline of that process probably won't surprise someone like you, which is that most of them were garbage. I'd say about 80% of them had effectively no predictive value at all. And it's a good, I think, reminder to us as market participants that so much of what passes for analysis and so much of what passes for insight into where the markets are headed or how they're doing is not all that instructive or all that useful. But of the remaining seven or so, I weighted them by sort of their utility historically, and it ended up being things like valuation and momentum, which again, momentum has about a 200-year plus track record. We have evidence of momentum even in biblical times, so, much longer than 200 years ago. And so some of these things have been around forever. They're still very instructive. So when you think about the markets today, I'd say the unsatisfying answer is it depends on how irrational it is. It depends on which market you're looking at, because there are parts of the world that are still very reasonably priced, and I won't, name individual securities or anything right here, or my compliance will rain down on me. But if you look around, there are parts of the world that have historical valuations that are very much consistent with long term averages, and in some cases are even depressed relative to long term averages. Other parts of the world, namely the US, are about as expensive as they've ever been. Now, the US has been expensive for a decade. I mean, there have been people who have been screaming about how expensive the US has been for the better part of 10 years. And there are plenty of folks who would say that the U.S. is expensive because the U.S. is special, or has characteristics of our market economy that are different or better than other parts of the world. But as sort of a dispassionate, rules-based investor, I can tell you that I'm overweight the cheaper parts of the world, and that I'm taking a little bit more of a wait and see approach on the US. So that's sort of how I think about it. What I found in my research is that these high valuations can persist for even a very, very long time. But when high valuations meet flagging momentum, that's when you kind of get in trouble.
Yeah.
So if you've got high valuations and hot momentum, it may make sense to take the ride. But when the momentum drops, you might want to watch out.
You've said a lot there that I want to kind of unpack. One thing that struck me, you said that some believe sort of the U.S. market is special, but it seems to me that whenever an asset price is high, however that's measured, we develop a narrative as to why that asset is special. We did that with tech stocks in the late 90s. We did it with real estate leading up to the real estate crash. I think today we've certainly done it with the U.S. market, and we've done it with crypto. And the interesting thing, it seems to me, is that the narrative we develop is factually correct, right? It's factually correct, I think, that the diversity of industry in the United States is probably unparalleled. Our regulations are probably the best in the world. Our markets are the most efficient. So or crypto, there's a limit to the number of Bitcoin, and yes, there's inflation with fiat currency. All of the narratives we develop are factually correct, but in the end, at least so far in history, ultimately don't support, at least long term, the elevated prices, and they come crashing back down. I'm curious if there's any sort of, I don't know, behavioral finance lessons to be learned in that for investors as they look, forward.
Yeah, well, so the power of narrative is just as you've suggested, and I'm in absolute agreement with you. I think the U.S. is probably deserving of some premium relative to much of the rest of the world. Whether that premium is 2x, 3x, which it currently is, if you look at the U.S. versus say emerging markets, I don't know that it's 3x. Right.
Yeah.
So, what is that premium? Probably impossible to pinpoint, but trees don't grow to the sky.
Yeah.
And every time we've had one of these narratives, that narrative has been corrected, I think, over the medium to long term. So I'm in absolute agreement there, and it's incredible how fast narratives change. Now, at the risk of sort of dating this podcast, we've had a couple of big down days recently, and then a couple of big up days as people are worried about this new COVID variant. And it's amazing that in the space of one day, I will see the narrative change. The narrative on one of the cable financial news channels in the morning, it will be, you know, investors are optimistic about the future, and then in the afternoon, it's investors see doom and gloom on the horizon.
Yeah.
So narratives can change very quickly, and when they do, things tend to sort of get back to more historical levels.
Yeah. The current market, it kind of reminds me of March of 2020, uh, when we didn't really know what we were dealing with, and the market was reacting. Of course, the swings that then were much larger. We were up 10%, we were down 10%, and in some ways, the current market feels similar to me. Just the swings aren't as big because while we may not still know what we're dealing with Omicron, I think that's the name of it. Um, uh, we know there's a risk out there, and so we're up 2% today. We were down whatever 2% yesterday, and so it's kind of interesting to watch. I'm curious though. I want to go back to one other thing you said. You mentioned that momentum investing is evident in biblical times. I gotta ask where that comes from.
So Chris Gacy has done, I think the name of the academic paper is The World's Longest Backtest or
Yeah.
something like that. And he's done research on momentum as a factor. And I'm gonna go read the paper. I'm gonna screw up here, but I mean it's like he's looking at grain prices in biblical times or something,
Ah.
and showing that they show momentum effects. Developed markets like the ones we have today are only about 400 years old, but like we can see it in a more informal setting like commodity prices, even thousands of years ago showed evidence of momentum. And the thing that I would tell the listeners is I think that the best investment factors all have an element of human behavior within them, sort of a kernel of human behavior, whether it's value, whether it's momentum, whether it's quality. All of these things persist for hundreds and thousands of years, because they have an element of human behavior to them.
Hmm.
Other sort of market anomalies, calendar effects, and things like that, there's no behavioral kernel to them. So the minute they're discovered, they're arbitraged away.
That's interesting.
But human behavior is timeless. It's endless, and people will be doing stupid things 2,000 years ago, 2,000 years from now. And so if you can discover a factor that has some behavior to it, I think you've got something you can lean on a bit.
Right, right. Well, it's interesting to me from your irrationality index that you looked at so many factors, but the ones that seem to really have some predictive capability are some sort of fundamental analysis, which as a value investor that makes perfect sense to me. But then momentum, because to me in some ways value is inconsistent with momentum. I suppose that they can be compatible, maybe, but to me, momentum is looking at price movement over periods of time, and it certainly does seem to be true that there's tend to be patterns, if you will, and at least until there aren't. Prices tend to go up or down until they don't, right? But it's hard for me to imagine Warren Buffett, say the sort of the grandfather of value investing, considering momentum. Of course, I don't know. Maybe he does. What do I know? But I'm curious how do you see those as sort of contradictory, or are there value momentum investors? Is that a thing?
Yeah, so it's interesting. I think much like you, I mean, I grew up again the son of a financial advisor, and I would say that my dad was steeped in a Grahamian sort
Yeah.
of Buffett-esque sort of way of thinking about the world, and so I grew up literally talking around the dinner table about buying a dollar for 90 cents, kind of thing. And so when I began to immerse myself in the study of markets, value investing spoke to my soul, right? Like this seemed like, yeah, this makes sense. I get this. But I would say to you that there's some really interesting research by Cliff Asness and others, that looks at the combinatorial power of value and momentum together.
Hmm.
These are two camps of people that see the world very differently, and even sort of personality wise. I would say that the value camp is usually boring folks like you and I, and that the momentum folks
I'll
tend to be,
accept that.
and that the momentum folks tend to be a little more high flying. But what I've found in my research is that by combining them, there's some power, because it's almost as though, when you can put them together, it's peanut butter and chocolate. So I struggled for a
Oh, I
long
love
time.
Reese cups.
There you go. Best candy around. But momentum always seemed like voodoo to me.
Yeah.
And it took a really long time for me to sort of come around. but the academic research is undeniable by people I really respect. Cliff Asness has written the best paper. It's called Momentum and Value Everywhere, or something like that. I'm apologies to all these great thinkers whose papers I'm screwing up the titles of.
Well, I'm
But
Googling it right now, and you're right. Value and momentum everywhere.
oh,
Is he
good.
in NYU?
Good, good, good. So, yeah, this is a fantastic piece that'll bring these two sort of disparate camps together. And I think if you can pair them together, it's a powerful, powerful combo.
So I had this nice sort of list of questions I wanted to ask you, and I can tell you we're about a mile and a half away from that, but that's okay. I like where this is going. Um, so, as a value investor, maybe someone who also uses momentum, if I understand your sort of philosophy, how does that apply, if at all, to crypto? Because as a value investor, I've stayed away from crypto. I don't own any Bitcoin. I do own a minuscule amount of Ethereum uh, because I can't value it. I can't determine. There is no value, at least not from my way of thinking, from a fundamental analysis. It's not subject to that. So does that mean as a value investor, I just need to avoid crypto, or how do you look at crypto?
So I feel like I've had to change my tune about crypto a little bit, and nothing like price to change narrative, right? So again, as a value oriented guy, most naturally, I mean that's who I am, sort of at my core. So I think I get where you're coming from. When crypto first came onto the market, it was just absolutely magic beans to me. I mean, I heard about it very early and was just like, candidly, this is nonsense. Like, this is magic internet money. This is crazy. There's no way to value this. I won't put 1 cent into it. And I really had my mind changed a bit. I don't know, 4 years ago, maybe. Patrick O'Shaughnessy, who has an excellent podcast, did a 3-part series breaking down crypto. I still think it's the most accessible take on crypto I've ever come across. Crypto is a hard space because I think there are rabid evangelists who are often sort of foaming at the mouth with their enthusiasm for crypto, and then there are haters, I think, who have not even looked into it sometimes, and are hating it for reasons sometimes of having missed out. And it's hard to find sort of the sensible middle path, someone to talk about it in a rational way. And I thought Patrick did a nice job of that. So I don't own a lot of crypto. I have a very, very small amount of crypto because I'm like you. I have a hard time valuing it. That said, I have come around a bit, and I think that crypto has promise. I think crypto has promise in a lot of ways that are candidly being unevenly met right now. I think, like any emerging technology, there's a lot of nonsense. There's a lot of scammy stuff. The same could be said of the early days of the internet, but I do think now that crypto shows some promise that I hope that it fulfills. There will also be, for every one promising crypto, there will be 100 scammy, get rich quick, fly by night schemes. And I think we have to be humble. I think I wasn't appropriately humble when I was learning about crypto early on. I was immediately dismissive. And I think if crypto's taught me anything, it's to be curious and inquisitive about things rather than immediately prosecuting or proselytizing them. That's going to be sort of my takeaway from crypto.
Well, I think that's a great point, and I've been very negative on crypto as well as an investment, uh, and I still have significant concerns. Uh, but I guess it kind of leads to the next topic I want to talk about. We all have different perspectives. I guess we have call them a bias. Minds towards value investing, right? And the problem though with that is that if taken to an extreme, like you said, it zaps you of curiosity. It closes doors before you've really evaluated something. And I'm curious if you have thoughts on, I think a lot of times we have a bias for or against something and might not even really appreciate it that we have that. So how do we identify those sort of, I don't know if they're emotions or perspectives. How do we identify them in our, in our approach to investing so that we can evaluate them and decide whether these are the right ways to think about the world or not?
Yeah, so what's tricky about investing is that, whether or not something is quote unquote right, is it's hard to determine the timeline against which to make that appraisal,
Mm,
right? I mean, you could say value investing, this highly scientific, sensible, validated form of investing has been quote unquote wrong for a decade, right? So have you been wrong to be a Gramian value investor for the past decade? Well, that seems premature to me. And my friend Corey Hofstein did an analysis that looked at how long you would have to hold an investment to truly be able to say whether or not it was the quote unquote right,
mm,
and it was about 30 years. and so and so most of us don't have that kind of time, and we're not making, let's be honest, we're not making investment decisions saying, well, I'll check back in 30 years and see if this was a good idea.
yeah.
Most of us don't have that sort of patience, even boring folks like the two of us. And so the thing that I would look for is just evidence of three things. I look for evidence in philosophically, right? There needs to be a reason why it makes sense. So here's a good example. Historically, there's been about a 96% correlation between the production of butter in Bangladesh and movements in the S&P 500. Now, if I approached you with a Bangladeshi butter production hedge fund and asked you to invest, you should laugh in my face, right? Because philosophically, it's stupid. Like there's so many disparate pieces of data out there that if we regress enough of them against each other, we're going to find some spurious correlations. So philosophically, does it make sense to you, right?
Right.
That's step one. The second step is there data to support it? Does that philosophical sense show up in the numbers? And it does in things like value and momentum and quality investing. And then the third thing is there a behavioral factor? Is there a behavioral reason why this would persist? And if your style of investing ticks those three boxes,
Mm.
I think you're on to something, even though it may suck for 10 years. Like, even though you may be frustrated with it for long, long stretches of time on a relative basis, I still think you've got something there.
Interesting. You've mentioned momentum many times today, and I wonder if you could just describe for us what momentum is, and if someone wanted to incorporate, I guess I'll call it a philosophy, I don't know, but that approach, how would they do it? I mean, I suppose they could go buy a momentum ETF of some kind, but maybe how you incorporate momentum into your investment philosophy, if you do.
Yeah, so I will take a crack at it. There's better people than me to speak to this, but basically it's just the idea that there's information and price, and that strong price action begets further strong price action, at least in the short to mediate term. What we see is that there are positive momentum effects at the 6 month and 12-month period, but at like the 3 to 5 year period, you actually tend to see mean reversion. So stocks that have done well for 6 months, the price action's been strong for 6 months, tend to do well for a further 6 months or so, but stocks that have been hot for 5 years tend to cool down.
Mm,
So that's one thing to think about. For the average investor, and I very much include myself in this category, I think that if you want access to momentum, you should get it through a low cost diversified ETF or separate account strategy. You should not try to be
Yeah.
running this kind of stuff on your own. It's often a high turnover strategy. It's a complicated strategy, and I think you could eat yourself alive with complexity and fees if you're not careful. The other thing that we know is that momentum tends to get crushed in bear markets. It tends to do very well in up markets, but again, momentum gets really rocked in bear markets. One of the things that I like to look for is call it these value and momentum combos, because it's sort of like a cheap stock with a head of steam is the way that I think about it, because heaven knows value stocks can languish in obscurity for longer than you want to hold them,
Yeah.
but an attractively priced stock with a little bit of momentum, I think, tells you with a higher degree of certainty that yes, people are starting to pay attention, people are starting to take notice, and so, you never know for certain, but fingers crossed, this is hopefully not a value trap, and maybe it's headed somewhere, headed for better days.
Okay, good. Well, thank you. Um, let's sort of switch gears a bit and talk about fear and greed. And specific, we can use fear as an example. Uh, and I'll use, it could be anything, but we'll use retirees who are afraid of running out of money in retirement. That's a pretty common fear among folks that have gray hair like I do. Uh, sometimes sometimes you should really listen to fear, right? Sometimes fear is trying to tell you something really important that you shouldn't ignore, and other times it's more of an illusion. You're afraid of something for no good reason. But our emotions in those times, whether it's in this case fear or whether it's on the opposite end, maybe greed, they're really powerful. Uh, and I'm wondering if you have any insight on how, as an investor, you figure out whether the fear you have is something you better listen to or whether it's something you should ignore.
Yeah, I think it again needs to be checked against the data, because you use this a great example, which I think is perhaps the most common example, like, right, this fear of cat food, or fear, fear of running out of money. Um, the fear of running out of money can lead you to be excessively conservative, right? I think that's one of the most common things that I see is folks, as they enter retirement, they enter a fixed income, they go, okay, well, let's hit the brakes now, because I'm scared of running out of money. So let's get super conservative. When my kids were born, I have young children, and I remember when my first child was born, the nurse said to me, this child has a 1 in 3 chance of living to be 100 years old. That kids this age are living to be 100 years old. So if we're all going to grad school, retiring at 65, and then working, yeah, and
Yeah,
then living for another 40 years after our 30-year career is up, I mean, you have to continue to take market risk. So
yeah,
one of the things that I would say is that sometimes in our very efforts to avoid the thing we're scared of, we bring about the inevitability of that thing upon ourselves, right? It's like when I was counseling and people would go, well, I'm scared of being hurt. I'm scared of being lonely. So I'm just not going to date. Well, that's a good way to be lonely. That's a good way to ensure that you'll be lonely. So is that thing are you really addressing that fear, right? Are your actions consistent with the fear? Because if your fear is running out of money, the thing you need to do to appropriately address that fear is to allocate in a way that keeps up your purchasing power and at least keeps up with inflation. And so I think the critical question is the thing that I'm afraid of, which may be totally legitimate, right? It's not that we should just be explaining away fear. That's a legitimate concern for lots of people. Is the fear legitimate? And then are the actions that I'm taking addressing that fear? Or are they exacerbating the likelihood that that fear becomes
yeah,
realized?
yeah, yeah. Have you in your research have you found certain, I guess, personality traits that successful investors tend to share?
So, people who are interested in personality research, go check out the Big Five model of personality. More so than some of the pop garbage that people love to reference. The Big Five is the most reliable and valid measure of personality, and it spells out ocean or canoe, whatever your preference is. But the O is for openness to experience. The C, like how willing are you to try new things. The C is for conscientiousness, which is effectively how anal are you, like sort of how organized are you.
Technical
Uh,
term.
yes, yeah, that's the scientific term for it. Actually, it is. That's Freud's term.
Oh,
Uh,
okay, good. See there.
Anal retentive, that's Freud's term, yes. The E is for extroversion, which we all know about. The A is for agreeableness, which is sort of how, if your partner says, "Do these jeans make me look fat?" Do you, do you give the honest answer, or do you give the tactful answer? And then
Tactful.
in that, yep, there you go, smart person. And then N is for neuroticism, which is your sort of your level of worry. So the two of those five that are going to have anything to do with investing success, because things like extroversion and openness do not. The two that are going to make a difference are conscientiousness, which is sort of your level of organization and preparation, and neuroticism, which is your level of fear. So, neuroticism has obvious correlates to things like risk taking preferences, and conscientiousness is the best predictor of job performance. So,
Hmm,
people who are highly conscientious tend to be, you know, the kind of people that keep their jobs and get promoted and
interesting.
things like that. So check out the Big Five. But yeah, the two are sort of how conscientious are you and how neurotic are you would be
Mhm.
the two big factors that have anything to do with investing success.
I wonder how much humility plays into it, particularly if you've achieved some level of success. How your ability to really accurately analyze why you were successful. Why was a particular investment successful? Did I understand something in the market that no one else did, or did I just get lucky? Right?
Yeah, you just got lucky is almost always the answer.
That seems about right.
Yeah, the humility is so critical. Jim O'Shaughnessy wrote this book, What Works on Wall Street, that talks about a lot of the factors that we've discussed today. I'd recommend it to anyone. But, one of my favorite lines from the book is I'm gonna, again, like I have been all episode, butcher the quote, but it's effectively saying, the fundamental attribute of a great investor is realizing you're just as flawed and biased as the next person. Like the best thing you can do at the outset of this investing journey is to say, I'm not special. We as a human race are by and large overconfident, and we're overconfident in a couple of predictable ways. We think we're better than other people, at whatever it is, smarter, better drivers, whatever.
Yep.
We think we're luckier than other people, right? When you ask people to rate their likelihood of divorce and getting cancer or whatever bad stuff, it's vanishingly small, even though we know that half of people get divorced and lots of people get cancer. And then we think we're better at predicting the future than we actually are. And so I think the best investors combat all three of these sort of forms of overconfidence and take Jim's advice and say, I'm pretty much like the next guy or gal, and I'm just gonna diversify and kind of get out of my own way.
Okay, good. But that may be my mantra every morning when I wake up. I'm not special. I'm not lucky. I'm not
So
the
you mentioned
opposite
my
of.
you mentioned my TED Talks. My first TED Talk was a TED Talk called "You're Not That Great," and I wrote an accompanying book on it, and it sold like 10 copies because nobody is trying.
No one wants to hear that they're not that
Nobody
great.
wants to hear. Nobody wants to hear that.
Well, let me raise one last topic with you, and I appreciate your time today. But it actually goes back to a TED talk because you had another one about how folks who are weird can actually achieve great things. So tell me about that. What's weird? What makes someone or someone weird? What do you mean by that, and why do you think that might lead to some good results?
Well, in the sense of being weird in the market, I'm talking about it being a contrarian investor, which is certainly near and dear to the heart of a value guy like you. But more broadly, I encourage people to sort of own what makes them different.
Mm,
So there's interesting psychological research on perceptions of power. And what we see is that people who whatever, dress a little differently, have a little bit of a different haircut, wear a little bit of a louder suit, whatever. These people who take sort of small deviations from the norm are seen as more powerful, more credible, and more likable than the people who are sort of falling directly in line with every corporate mandate. Now, this is not to say that you should go, be inappropriate or crazy at work, but this just shows you that letting your individuality flag fly a little bit is actually really well received by people. And I think very often people think that the road to success is paved with sort of conformity and getting in line. And what I'm encouraging people to do is to understand the literature that says, yes, you do need to, 80% of the time you need to do, sort of what's mandated by society, but you can carve out that 20% of you just being who you are. You can show that to the world and know that that vulnerability makes you more likable. There's this famous research, it's called the pratfall effect, and they looked at politicians who kind of screwed up or flubbed their lines and found that they were actually more likable than those with sort of a perfect delivery. So what they found is like we don't want sort of robotic perfection and we don't want incompetence, right? They looked at people who are just sort of bumbling and stumbling over every word. Nobody likes that in a leader. But likewise, we don't like perfection. We want people who are competent but flawed individuals.
mm.
And so don't be afraid to be competent and to, to follow most of society's norms, but when it makes sense to be that 10-20% different and be honest about who you are.
I wonder how much of all of that comes down to how important it is to someone that they are well regarded by others.
Yeah,
Uh,
well, it's agreeableness is it's
yeah,
kind of back to that agreeableness
yeah.
factor of personality.
I mean, because it's I guess you could take that to an extreme and not give a hoot about what anyone thinks, and that strikes me as probably not optimal. That extreme,
Yeah.
but you can take it the other way and only care about what how you're perceived, and then you basically maybe eliminate whatever it is that makes you unique, at least
Yeah.
outwardly. At least outwardly.
Yeah, I mean, I think you see this on TV sometimes. We have these like I don't care what anyone thinks type characters in TV shows sometimes. That makes you a sociopath. We're not asking for that. We're not asking for that. But just not being afraid to let your individuality show.
Yeah.
Relationships are deepened through disclosure, difference, and vulnerability. And I'm just encouraging people to bring that to the workplace in a way that I think is sometimes discouraged.
Well, great. Well, Daniel, thank you so much for your time today. If folks want to follow your work, I know you're on Twitter. I don't know, maybe that's where they go. Where should they go? I know you've written a number of books, not to mention TED Talks, but where should they go to follow your work?
Yeah, to learn more about my work, I'm on Twitter at Daniel Crosby, LinkedIn, Daniel Crosby PhD. Love for you to tune into my podcast, Standard Deviations, like you said. And then, yeah, read my books. The two best books I've written are The Laws of Wealth and The Behavioral Investor. So I'd love it if people would go check those out.
Great. Well, great. Thank you so much, Daniel.
My pleasure.